Welcome, crypto fam, to the #1 daily Bitcoin pod. In today's show, I'll be breaking down the latest Bitcoin technical analysis, as well as breaking news. President Bukele proposes Bitcoin Bank to attract billions. We'll also be discussing crypto chief bids SEC farewell after 9 years of service. Adios, amigo. We'll also be discussing Bitcoin Runes racks up over 2,500 Bitcoin in fees in just under 2 months, as well as corporate adoption is in the amateur league despite these Bitcoin ETFs. We'll also be discussing the Bitcoin mining cost on average right now is $86,700, as well as BlackRock allocation recommendation of 84.9%. It's Bitcoin would take us to a $47 million Bitcoin price. And according to Samson Mao, the math checks out. I'll be breaking down this math for you. We'll also be taking a look at the overall crypto market. All this, plus so much more in today's show. If you're new to the channel, important to smash those likes and subscribe to the #1 daily Bitcoin pod. Also important, hit the bell notification. Turn on all notifications. I meant the bell icon, but yeah. But anyways, family, today is pod episode number 1673. I'm your host, JV. It's June 17th, 2024. Let's kick it off with our market watch, as we do each and every day. We got virtually the majority of the cryptos, unfortunately, in the red. However, XRP is a top gainer in the green, back above 51 cents. Look at that, up 5% on the day. And checking out coinmarketcap.com, we're currently sitting at a 2.42 trillion market cap, and the current Bitcoin market cap still sitting pretty above 1.3 trillion. And checking out the top 100 crypto gainers for the past 24 hours. Again, XRP leading the pack, trading at 51 cents. There was some more recent news. The SEC wanted to settle the fine, I guess, for the whatever the lawsuit was. And they initially wanted $1 billion. And then, I think they created an appeal or something and argued. And now the SEC is wanting $100 million. Let's see if they settle for $100 million or if it lowers some. Let me know your thoughts. We have Tron barely in the green, virtually only a handful, even barely in the green, because the majority of the market's correcting at this time and in the red. And checking out the crypto bubbles to get a visual perspective on the daily. Massive losses, unfortunately. But zooming out on the monthly, yikes. Still like 80, 85% losses, only a handful in the green. And checking out the Crypto Greed and Fear Index, we're currently rated a 71 greed. Yesterday, 71. Last week, a 72. And last month, a 73 in greed. So there you have it, my crypto fam. Bitcoin price risks 62,000 dip as Bitcoin sellers return to the exchanges. That's right. Here we're looking at the Bitcoin 1 hour chart on your screen. Bitcoin extended losses into the June 17th Wall Street Open as the bulls failed to mount. Comeback. Don't call it a comeback. Bitcoin's been here for years, peer to peer. Yeah, but anyways, TradingView showed Bitcoin drop into 65 Gs on Bitstamp, nearly matching 1 month lows from June 14th. A modest uptrend over the weekend failed to sustain during the week's first Asia trading session, with the US markets continuing the lackluster mood. Yeah, unfortunately. However, quoting analysts here, this is where you'd want to see Bitcoin form a higher low, or it starts looking like 62 is on the menu, according to crypto analyst Jelly. Red Monday, green week. We shall soon see, family. Now, traders held various support levels in mind, these extending down to 60 Gs, with multi-month lows on the radar should that level also fail to hold. Now, 65,000 represented a major focus in terms of liquidity. On the day after, 66,000 disintegrated. Quoting CoinGlass, Dan Crypto Trade. Bitcoin liquidity level at 65 and 66.3. Keep in mind, there will always be levels on both sides, and these don't always get tapped. These levels can act as a magnet when the price trades close to it. So there you have it, yo. The trader Crypto Tony highlighted 67.3 as a level to flip to support for those considering going long BTC. And the chart shows an inverse head and shoulders pattern, potentially causing for optimism should a local low be completed. Meanwhile, gauging market reactions to the latest Bitcoin price moves, on-chain analytics platform CryptoQuant noted the uptick in coins being sent to the exchanges. Particularly in focus were coins that last moved between 3 to 6 months ago, as well as those dormant for up to a year, quoting Crypto Quant here. 40% of the cent Bitcoins are in the 3 to 6 million range. 20% are in the 6 to 12 million range. And the remaining portion is mixed. These cent Bitcoins will create selling pressure. This analysis covers the short term, indicating that after a certain rise, the selling pressure will increase, and it looks like we will enter a free fall again. And in other breaking news, El Salvador's president, Mr. Bukele, proposes Bitcoin Bank to attract billions. And quoting the high priest of Bitcoin, Max Kaiser, President Bukele hits ground running in new term with new legislation establishing a Bitcoin Bank in El Salvador. Borrowers can collateralize their pristine, no counterparty risk Bitcoin, the most pristine collateral that ever exists. Billions of Bitcoin will flood into El Salvador's upping GDP. El Salvador's credit rating hits IG within 24 months. Kathy Wood's 10x GDP growth estimate in 5 years just got way more likely. So you're ultimately going to have financing options to borrow against your biddies, which is fantastic because this doesn't really exist here in the United States at the current moment. In fact, you walk into the bank and you say, yo, I'd like to borrow against my Bitcoin. Let's go. They're going to look at you like you're crazy, like, oh, we don't accept Bitcoin. They don't even recognize it. And I don't even think they could allow it because of the regulations and the rules and all that such. But I think this will set precedent over in El Salvador, and I think many countries are going to follow in their footsteps because you're going to see a mass exodus of people leaving the United States, as they already are, and head into El Salvador, obviously, as Bitcoin country. Imagine being able to hypothetically take a Bitcoin or a few Bitcoin, borrow it, right? No questions asked, none of the BS. And then you get the cash. You can buy your dream home. You can buy your dream Lambo. And granted, you are responsible as an adult and you pay back the loan, you're going to get all your Bitcoin collateral back. Can things go wrong? Yes. You don't ever borrow money you can't afford to pay back. Then they take your collateral. You got to keep that in mind. You know what I mean? And someone may ask, but isn't self-custody the smartest way to go? Why would I put it in? Yes. If you're hodling Bitcoin, there's no questions asked. Self-custody is king. No question asked. Unconfiscatable Bitcoin. However, you may be in a position where you're like, yo, I need to buy something, but I don't want to sell my Bitcoin. Well, now you can borrow against it very soon when that bank opens in El Salvador. So I'm pretty excited for that. Let me know your thoughts, family, and where do you feel the price action is likely to take us for this month of June. But anyways, fam, we got a lot to share. If you're just joining the stream, welcome. But let's dive into our next story of the day. Crypto chief bids SEC farewell after 9 years of service. Why don't you take Mr. Chairman Gary the Worm Gensler along with you, crypto chief? Just saying, speaking on behalf of the broskies. So yeah, David Hirsch, chief of crypto assets of the US SEC, has officially announced his departure from the agency. Let's celebrate. On June 17th, Hirsch, who began his career as a staff attorney at the SEC, announced on LinkedIn he is finally leaving his post at the financial regulator after nearly 9 years of service. Reflecting his time at the SEC, Hirsch expresses immense pride in the work accomplished by the agency's crypto asset and cyber unit. Womp womp. Quoting him here, "This past Friday was my last day with the SEC after almost 9 years. During that time, I had the opportunity to work on more complex, challenging investigations and issues that I ever imagined when I joined the agency as a staff attorney in the Fort Worth regional office." Now, Hirsch credited his success to his colleagues, collaborative efforts, and the support of mentors, leaders, and partners across various regulatory and law enforcement agencies. So this guy is actually flexing about his success at the SEC. Womp womp. "I am deeply indebted to my many mentors." You better not mention Gary Gensler, bro. You better not. "Leaders, colleagues, and friends to name here. And that includes amazing partners across the state, federal and international regulators, and law enforcement." Now, the former SEC official also said the securities enforcement is a team sport. It's ironic they look at it as a sport, for Christ's sake. Hirsch highlighted that this was true during his tenure and thanked his colleagues for their efforts towards the same goal, while the former SEC official said that it's difficult to leave the agency, which has given him a lot. Hirsch said that he was excited for the next set of challenges that may come his way. However, the former official said he would take a break before announcing his next endeavor. Quoting him here, "I look forward to sharing more about that soon. And my guess FYI, he's going to join a crypto project, mark my words. But for now, I'm excited for a break and travel with my family before my son heads to college in the fall. Hirsch has been an enforcement attorney for the SEC since 2015, started his post as the chief of the agency's crypto asset and cyber units division back in October of 2022. The official worked for the agency for 8 years and 10 months before announcing his departure. So there you go. But anyways, fam, next story of the day, because we got a lot to cover. Let's discuss the latest with Bitcoin runes, racking up over 2,500 BTC in under 2 months, 60 days, 2,500 BTC. Good Lord. That's right. The runes amassed over 2,500 Bitcoin worth of transaction fees in less than 60 days, signaling the growth of the Bitcoin native DeFi. Runes, a new protocol for issuing NFTs and fungible tokens of the Bitcoin network, generated 2,513 BTC in total fees since launch, worth 163 million, according to this data by Dune. The milestone comes 2 months after the launch of the Runes protocol, which happened on the same day of the Bitcoin halving, and signaling continued interest in the potential of Bitcoin native DeFi or Bitcoin Fi, BTC Fi. Haven't heard of that term. Now, additional transaction fees from protocols like Runes could extend a significant lifeline for the Bitcoin miners post-halving, after the Bitcoin block rewards were recently cut from 6.25 BTC to 3.125 BTC. Bitcoin runes are becoming the dominant standard for issuing fungible tokens on the world's first blockchain network. How many of you have experimented with either the ordinals or runes? Let me know. Looking at the distribution of transactions, runes-related transactions accounted for 12.2%, while BRC20 transactions amassed 5%, and ordinals inscriptions accounted for 0.6% of the total transactions on the Bitcoin network. Over 82% of the transactions remain regular Bitcoin transactions as of June 17th, according to Dune. Now, in terms of daily transactions, there were 9,567 runes-related transactions, with just 3,938 BRC20 transactions and 474 ordinals-related transactions. Regular Bitcoin transactions stood at 64,620. Runes have been outperforming BRC20 tokens in terms of on-chain activity since their launch in April 2024. The rise in transaction fees from Bitcoin runes is offering a lifeline for the Bitcoin miners, according to the co-founder of TerraWolf. Quoting him here, Runes significantly increased the transaction fees. So if anything, there was an increase in the hash price in the first 24 to 30 hours after the halving. Since then, we've seen transaction fees come down, but compared to the average fees in 2023, they're still pretty high. And as the rest of the Bitcoin block reward is fixed with issuance, the transaction fees are the wild card for the Bitcoin miner. So ultimately, I mean, runes and all these inscriptions and ordinals and BRC20s are very beneficial to the miners. They can make more money as it congests the blockchain, raising the fees. However, it's not necessarily a good thing for the ordinary Bitcoin user just trying to make transactions on the, core blockchain itself. Now, if you use layer 2s, such as the Lightning Network, different ball game, because we can send virtually instantly and virtually for free using the layer 2s. So do note that, but let me know how many of you are interested or have been dabbling with ordinals or runes. Holla at your boy. Next story of the motherfucking day. Let's discuss these Bitcoin ETFs. Corporate adoption is an amateur league despite these Bitcoin ETFs. That's right. Corporate adoption and trust in the crypto industry are still in their infancy, despite the previous approval of the first spot Bitcoin ETFs, which officially went live on January 11th. They've already amassed over 1 million Bitcoin collectively, which is 5% of that circulating BTC supply. The regulatory approval of the first Bitcoin ETFs in the US were considered a turning point for the legitimacy of the crypto industry. Like, I needed to know we need Bitcoin ETFs for Bitcoin to be legit. Kind of hilarious, but hey, whatever. Introducing the first publicly traded Bitcoin products to the market. However, corporate adoption is still in the amateur league. Such amateurs. According to Mark Degen. What an interesting name. Mark Degen? You can't make this ish up. Co-founder and chairman of Trust Square, the blockchain-focused tech hub. Degen, shout out to all my Degens out there, said during his speech at the Web3 Corporate Innovation Day, corporate adoption is just complete utter failure. It's amateur league against the pros. To argue his point, the co-founder contrasted the inflows of the spot Bitcoin ETFs with inflows in traditional finance space. Quoting him here, everybody is stoked about Bitcoin ETFs, which collected about 60 to 70 billion year to date in inflows, and it's been roughly 5 months. All digital asset funds have a year to date inflow of about 100 billion. Well, that's half for JP Morgan alone delivered here in the last 10 years. And since they launched, the US-based spot Bitcoin ETFs have amassed 58.4 billion worth of the total on-chain holdings, according to Dune. In contrast, wealth management giant JP Morgan has brought in a record 489 billion worth of net new client inflows during 2023. That's crazy. This meant that JP Morgan alone had attracted over 8-fold more inflows than the 11 US spot Bitcoin ETFs combined. And we all know JP Morgan Chase is the largest bank here in the United States. The main reason behind the lagging adoption of digital assets is the lack of mainstream trust in the crypto industry. Illustrating the lack of mainstream trust, approximately 75% of the people who have heard of crypto said they aren't confident in the reliability and safety of digital assets, according to a June 2023 study by the Pew Research Center. What a great name for a research center. Pew. Despite its centralized nature, corporations are needed to create more trust amongst mainstream users, according to DGen. I mean, people in crypto got the best names. I'm just going to say it out loud. We have a lack in trust in the crypto market, and only corporates can solve this. Meanwhile, new crypto adopters tend to place their trust in corporate-backed centralized exchanges. Who are they talking about? I mean, crypto adopters prefer self-custody, but yeah, wet behind the ear noobs are going to do anything because they don't know any better. It just is what it is. According to Dune, cumulative trading volumes on DEXs reached a total 3.86 billion in the past 24 hours. This is just a small fraction, or nearly 5 times less than the 17.6 billion trading volume amassed by Binance, the world's largest centralized exchange. Now, looking at cumulative Bitcoin ETF inflows alone doesn't paint a complete picture of the uptick in institutional adoption since their launch. This is partly because of Grayscale's Bitcoin Trust, GBTC, accounted for the lion's shares of outflows, significantly impacting the total amount of cumulative inflows registered by the ETFs. For example, to date, GBTC sold 18,000 Bitcoin worth over 1.19 billion, accounting for the majority of outflows, according to Farside investor data. So there you have it. Anyways, fam, next story of the day. Let's discuss Bitcoin mining price right now is $87,000 for some miners to acquire a Bitcoin. So with the Bitcoin price at 66 G's, that's roughly a $20,000 difference. Let's break this down. We had a analyst, Ali Martinez, talking about how the average mining cost of Bitcoin right now, what it's looking like. The Bitcoin network runs on a consensus mechanism called proof of work, in which validators called the miners compete against each other using computing power to get the hash to the next block on the chain. Tick-tock, next block every 10 minutes. The entire network is audited. You know the deal. This computing power naturally has its running costs, with electricity being the most notable expense that the miners have to pay, given that it's a perpetual cost. The incentive for spending capital on mining operations lies in the block rewards that receive these validators upon successful adding for the next block. Obviously, mining expenses are different depending upon location, as electricity prices aren't the same everywhere. As such, the chart that Ali has cited from Macro Micro uses data provided by the Cambridge University on Bitcoin electricity consumption to find out the average value. Here's the chart you can see on your screen, which shows how the average mining cost on the Bitcoin network has changed over the past few years. Whoa. Big difference. As is visible in the graph, the Bitcoin average mining cost, colored in blue, had been between the price of the crypto earlier in the year. But recently, the former value spiked and has surpassed the latters. The reason behind this sudden increase is that there is another variable at play when calculating the average cost of Bitcoin mining. It's the issuance, or the number of tokens that the miners are minting daily. In general, the block rewards stay fixed in value and frequency, so the issuance of the network, which is nothing else than the sum of the block rewards mined in a day, more or less remains fixed as well. Specific events, however, don't abide by this. They are the halvings. These periodic events that take place approximately every 4 years permanently slash the block rewards in half. The latest such event, the fourth ever in crypto's history, occurred back in April on the 19th. Naturally, the halvings mean that the cost of mining 1 Bitcoin drastically goes up, as miners only get half as many rewards as before after doing the same amount of work. Thus, it's not surprising that the cost of production for Bitcoin observed a sharp increase coinciding with the latest halving. At present, this metric stands at $86,700, meaning that according to Macro Micro's model, the average miner would be underwater. And based on the past trend of the indicator, Ali has identified a pattern that Bitcoin has always followed. Quoting him here, historically, Bitcoin always surges above its average mining costs. Facts. Now, as such, if this pattern continues to hold for the current cycle as well, then it may only be a matter of time before Bitcoin surges past $86,700 per coin. Send it and let's freaking go. You already know, family, and the miners know this, so they're holding on tight. Unfortunately, some of the, smaller miners that don't have the capital, it may be harder for them, but the big miners have been preparing every halving, just as history has shown us, because eventually the Bitcoin price will catch up with that. Bitcoin price follows the hash rate, and as long as the Bitcoin hash rate continues breaking out, reaching new all-time highs, game on. Just saying. Now for our feature story of the day. BlackRock came out with a very bullish publication back in 2022 suggesting investors allocate 84.9% of their portfolio into Bitcoin, suggesting Bitcoin to hit $47 million per coin. I'm going to break down some of the math, and even Samson Mao says the math checks out. So let's start first and foremost with this tweet that I shared a while back, with BlackRock allocating their optimal portfolio allocation into Bitcoin of 84.9%, according to their very own study released in 2022, which I'll read to you here shortly. That will send the Bitcoin price to $47 million per coin. Samson wrote, the math checks out. Bitcoin is going to $47 million and the crowd is going wild. In fact, there was a recent headline, BlackRock signals a paradigm shift with 84.9% Bitcoin allocation. And in other breaking news, as I shared earlier, shout out to all my stack and fifth level Bitcoin G's who front ran Finkster and BlackRock, because check it, just in, BlackRock and Fidelity now own a combined 477,121 Bitcoin, worth $31.4 billion for their spot Bitcoin ETFs. These ETFs hold 262,721 more Bitcoin than MicroStrategy, and they achieved that in 5 months since January 11th of this year. It took MicroStrategy since 2020 to acquire 214,000 Bitcoin, and as we announced the other day, Saylor is purchasing yet another 700 million worth of biddies from MicroStrategy, so things are about to get lit. So yeah, check this out. Last summer, BlackRock put out a paper stating that starting with a 60-40 equity bond portfolio, the optimal Bitcoin allocation is a large 84.9%. I'm going to read what's highlighted here for you on the screen. Exhibit 4 presents the results starting with a 64 equity bond portfolio, which is produced with a risk aversion of Y equals 1.5. The optimal Bitcoin allocation is a large 84.9%. Now do the math. What would happen if all the major asset managers, BlackRock, Fidelity, they all put 85% of their portfolio into Bitcoin? Game on. The remainder of the portfolio, 15.1%, is split 60-40 between equities and stocks, although Bitcoin has an extremely large volatility of 1.322. The pronounced positive skewness leads to a large allocation and dominates in the utility function. And then they go on, the certainty equivalent compensation required to not invest in Bitcoin is close to 200%. Exhibit 4, starting at a 2080 stock bond portfolio, leads to a 12.5% Bitcoin allocation, and a risk-tolerant investor with an 80-20 stock bond portfolio desires a leverage position in Bitcoin of 106.6%. Now, Kathy Wood has made bold predictions. If Bitcoin even got an allocation from the major asset managers of only 5%, Bitcoin can hit 3.8 million per coin by 2030, which I shared with you here in the show. So yeah, this is extremely bullish, and this is directly from BlackRock. So Samson says the math checks out. We're going to 47 million. Here's some of the math. BlackRock has, at that time, only 9.4 trillion in assets under management. Now it's clearly over 10 trillion. 0.849 for the right Bitcoin percentage, 7.98 trillion. Then BlackRock will need to allocate to Bitcoin to follow their paper. 7.98, 118 billion of a multiplier equals $941 trillion market cap, referring to the total addressable market. So Bitcoin will be about $47 million per coin. Send it and let's frickin' go. And in other, tweets here, let's see what other data I got. He also wrote in 2022, released that study, which I just shared with you. Obviously very bullish. He also recently tweeted, I know Bitcoin is going to $100,000, or I should say 1 million, my bad. Bitcoin is going to $1 million. The only question are when and how rapidly. Amen to that. We all know it's inevitable. 100% with you on that. But let's dive a little deeper into the newer article published on this event and why it's so significant. In a significant departure from the traditional stance of cautiousness towards cryptos, BlackRock's world's largest asset manager published a research paper, which we covered several times here on the channel, just FYI, advocating for an aggressive allocation to Bitcoin and traditional portfolio investments. Aggressive keyword, aggressive allocation. The research paper, titled Asset Allocation with Crypto, Application of Preferences for Positive Skewness, suggests that Bitcoin should make up a substantial 84.9% of an investment portfolio consisting of 60% equities, 40% bonds. The BlackRock researchers conducted an in-depth analysis of Bitcoin's performance and returns. During this period, they found out Bitcoin exhibited considerable volatility with an annual rate of 132%. I read with you already some of the direct study from BlackRock themselves. What sets Bitcoin apart is the positive skewness when expressed in terms of continuously compounded returns. In contrast to this, equity returns showed a percentage of negative 0.43%, while bond returns were at 0.01%. So you basically guaranteed to lose with equities, and you will lose with bonds because 0.01% is practically zero, especially when you're dealing with inflation, family. Bitcoin's third central moment of returns was an astounding 144% annually, demonstrating a stark contrast to traditional equities and bonds. This unique characteristic of Bitcoin returns makes it an appealing asset for investors seeking substantial gains. That's right. The research also highlights Bitcoin's consistent propensity for significant gains. While returns often follow standard patterns, there are exceptional periods labeled as bliss regime, during which Bitcoin price soar over 100 times annually. This level of return potential is what attracts investors aiming for substantial profits. Even when Bitcoin is expected to depreciate in the standard scenario, the research noted that investors focused on maximizing profits tend to allocate 3% to Bitcoin. This allocation remains consistent even when there is only a 1% chance of a highly profitable scenario materializing. That's right. BlackRock's recommendation to allocate a substantial 84.9% to Bitcoin in a 60-40 equity bond portfolio marks a significant departure from the conservative approach traditionally taken by many financial institutions towards crypto. Now, it underscores the growing acceptance and recognition of Bitcoin as a legitimate asset class that can offer substantial returns. This move by BlackRock follows the US SEC clearance for BlackRock and the 10 other, Bitcoin ETFs that officially went live on the 11th. But I want to know your thoughts surrounding this math. I mean, this guy is going to crazily continue to stack in the biddies because he's a smart man. He knows what's up. His goal is to tokenize the world, and clearly, they're not slowing down. They're going to continue to gain momentum. And considering the ETFs in the United States have already collectively achieved over 1 million Bitcoin, that's 5% of the Bitcoin circulating supply, and they did it in 5 months. That's an average of 1% of the Bitcoin circulating supply per month. What's going to happen in the next 36 months from now? You let me know, family. And what are your thoughts surrounding this 47 million price prediction based off the 84.9% allocation? Holla at your boy. I'm going to read as many of your comments out loud. Welcome, family, to the Q&A segment of the live show. Pump the likes to pump the stream. Over 1,100 people here live and in the flesh. I love it.